As a new passive investor or someone interested in becoming one, you are likely hitting a steep learning curve. There are many terms, deal structures, and markets to learn about along your journey toward investing in your first real estate syndication deal. Among other terms, there is cap rate, capital stack, NOI, ROI, and now IRR that you want to understand before diving in. You're not alone if you prefer to feel fully informed and confident in your education about a specific topic before investing a ton of money into it. Hi there, this is Harry Nima Segara, founder of Nima Equity. And today, we're going to learn what IRR is, how it's different from ROI or return on investment, how to calculate the IRR when looking at a deal, and why you should even care about the IRR. Why do passive investors need IRR and how does it help? Now you're dying to know what the IRR even is and how you would calculate it, right? IRR, internal rate of return, is the standard metric used to compare the return on your investment with the length of time included in the calculation. In contrast, ROI or return on investment calculations don't consider how long it will take to collect your returns. So if you could invest $100,000 and earn $200,000, is that a good deal? Before you respond, there are a few things to consider. Mainly the time it would take to collect that $200,000 should be taken into account. If it took 10 years to achieve those returns, I think you would be less excited than if you could earn those returns in only 5 years. The other question is, what return is being reflected by that $200,000? Is that overall ROI or annualized ROI? The shorter the whole period, the higher the annualized ROI, while the overall ROI wouldn't change. Now, if you're trying to choose between a 5-year value-add opportunity and a 7-year syndication deal, the ROI isn't very helpful. This is where you need the IRR, so you can include the length of time your capital is invested and accurately compare the returns you might earn, keeping it as simple as possible. It would be confusing to compare different deals of varying lengths, classes, and types without a clear IRR on each deal. And just in case you're just dying to relive algebra, here's the formula. Don't worry though, you don't have to calculate it yourself unless you want to. I like simplicity. So we provide the IRR along with a chart of other variables in each deal so you can see clearly how the IRR may be affected in the financial section of each deal's investment summary. Here are some fun facts. The IRR is negative until your returns equal the amount of capital you have invested. And then it's 0%. After that, when your returns surpass the amount of your initial investment, then the percentage starts to grow positively. The more monthly distributions paid to investors in a shorter time frame, the faster IRR turns positive. This is why in the past, monthly distributions and early sales were so popular because they made the IRR skyrocket. What variables impact the IRR? You may notice an easy-to-find IRR printed in executive summaries. The IRR moves as the cap rate moves. In the sensitivity analysis of the executive summary, you should be able to see a chart where a varying cap rate among other factors reflects an adjusting IRR. The asset class and strategy also intensely affect the expected IRR on any syndication investment. A stabilized A-class apartment complex may have a 7-year term with no refinance opportunity and an IRR between 13 to 15%. In contrast, a B-class value-add multifamily property may reflect a 5-year business plan, refi opportunity, and forced appreciation from the renovations that pushes IRR up into the 14 to 17 range. Although these are both apartment complexes, possibly even in the same metropolitan area, you're comparing two different appreciation strategies and two different classes. Adding streams of income to the property, increasing operational efficiencies, and getting units to market rents are all ways to increase IRR. Things like laundry services, mail delivery lockboxes, new property management, and payment software for tenants would drastically improve the experience for tenants and support higher rent rates. Whenever you can increase demand and raise the rental rates, the NOI or net operating income will get a bump and positively impact the IRR. What else to look for when comparing syndication opportunities? Other significant factor is, of course, the operator. Do you agree with their philosophy and the way they run their business? Do you know, love, and trust them? Other deal metrics to investigate and compare include the break-even occupancy rate, expense ratio, the deal structure, and loan or debt details. In general, If the break-even occupancy rate and expense ratio is low, the projections are more likely to be achieved. A special thanks for watching. I would like to extend an invitation to you to join the NEMA Equity Doctors Investing Club, where you can see actual projections and returns of real-life, past, and current syndication deals. Talk about sneak peek. Also, we dive into topics like real estate in general, finance, and mindset. Finally, let me know you like this video by giving it a thumbs up below. Do you happen to know anyone that could benefit from passive real estate investing? Feel free to share this video with them. Oh, and make sure you're subscribed too. I'm Harry Nima Segara with Nima Equity. Thank you for being here with me today.